Good morning and welcome to today's International Tax Update. As you are logging in, please keep in mind these best practices while using WebEx. Please be advised this session is being recorded. If you wish to be excluded from the recording, keep your camera and your microphone off. If you experience audio difficulties or if we get disconnected from WebEx, please dial in to listen to the presentation and enter the access code provided in your meeting confirmation. There is no need to click on the WebEx link and dial in. Please keep your mic muted throughout the presentation. To mute your mic, right-click on your name in the participant list. You may also mute yourself by clicking the mic icon at the bottom of your screen. To conserve bandwidth, turn off your video by clicking the video icon located at the bottom of your screen. Questions will be answered as time permits. To ask a question, please use the Raise Your Hand feature located to the right of your name in the participant list. During this session, we will be using Poll Everywhere to track participation for CPE credit. From your laptop or mobile device, open a Chrome or Edge browser and navigate to pollev.com/KPMG-tax525. This link was also included in the confirmation message you received under the CPE details section. Please enter your full name when prompted. In order to receive CPE credit, you must attend for the entire session, complete both the check-in and check-out steps in Poll Everywhere, and participate in all polling questions. At this time, please navigate to Poll Everywhere and submit your check-in. Please be sure to submit your first name, last name, and email address as shown on screen. Check-in will remain open until the first polling question. KPMG is approved by NASBA to deliver CPE-worthy training, adhering to the following guidelines. In order to receive CPE credit, you must attend for the entire session, complete the check-in and check-out, and participate in all exercises. Please note, participation is tracked and failure to participate will result in a denial of credits. I will now hand it off to Julie to begin today's session.
Hi, everybody, and thank you for joining. I'm Julie Schreckengoss, Tax Managing Director here in the Anchorage office, and we thank each of you for taking the time to join us today. Leonie will be sending out the slides at the completion of today's event, which will probably come out to everybody on probably Wednesday or Thursday. So if you don't receive those, please feel free to reach out and we can forward those on. Also, if you want to have a one-on-one follow-up with Marin after this, we are more than happy to get a time scheduled with you to chat with her and spend some time with her. And we will be having one more live cast in August, which will probably be on the topic of mergers and acquisitions. That's tentatively what we have scheduled, so look forward to details on that. We will be taking a break from holding these events during the months of June and July, since we know that we are busy, and as is everybody else, with summertime in Alaska. And again, thank you for joining. Feel free to raise your hand if you have questions during this live webcast or follow up with any member of your team, and we will make sure we get you connected with Marin and follow up on any questions that you have. And here we have Marin today to kick us off on the presentation.
Hello, everyone, and good morning. As Julie said, my name is Marin Isaac, and I'm a director in KPMG's international practice based in Portland, Oregon. And I have Charles Lewis here with me today. He's a manager in our practice in Portland as well. And so what we're going to cover today is to provide an update on international tax and cover some hot topics. And one of the bigger questions in international tax currently is whether or not there's going to be some upcoming tax reform. In 2017, we had the first major tax reform since 1986 that resulted in some significant changes for international tax. And now 4 years later, we have the possibility of some additional reform. So we're planning on this morning going through a discussion of what this reform might look like in the international tax space, and as well highlight some planning considerations that you might want to undertake as a result. And then following that, we plan to provide some international tax compliance updates as well. So I'm going to turn it over to Charles, and he is going to start us off.
Thanks, Maren. Hi, everybody. So I think just starting off, we what we're calling Tax Reform 2.0, just the potential tax reform that the Biden administration has released. So on March 31st, they released the Made in America tax plan, and it lays out some important changes with respect to our international tax system. And then a few days after that, the Senate Finance Committee Chair Ron Wyden from here in Oregon, he also released an international tax framework. And so today we'll kind of walk through the two frameworks, highlight some of the big ticket items, and then you know, as Maren mentioned, go over some planning ideas. We could go to the next slide. So our first knowledge check is just trying to get a sense of what you guys think about the current corporate rate, whether it's too high, too low, or if it's just right.
And I'll keep this polling question open for a couple of minutes as you proceed through the presentation, but it looks like most people are saying C, it's just right.
I would say there a lot of people agree with them. Cool. So as we start working through the various ideas really that are in the Biden and Wyden plans, the biggest one, and it's really, you know, the headline grabber, is increasing the corporate rate. Biden currently wants to increase, or had proposed to increase through his plan to increase it to 28%. Wyden didn't really specify, but we imagine he's also going to want to increase it. That seems to be a pretty hot political topic, and something that at least the Democrats are going to want to try to implement. The book-based minimum tax, which is the second one down here on the slide, is really an interesting proposal from the Biden administration, and is in line with what we've seen from the OECD and what they call Pillar 2, which is to institute just a base minimum tax on large multinationals. Historically, I should say the previous administration here in the U.S. didn't really play nice with the OECD and with other countries in terms of trying to implement this minimum tax, but the Biden administration, including this, is signaling a shift, at least in the U.S. tax policy, around wanting to work with, you know, our foreign partners and ensure that our really large multinationals are being taxed at an appropriate amount. As you see, it would be, you know, a tax on book income for companies that have net income of $2 billion or more, which is a fairly large company. And some of the predictions we've seen, that Maren and I have seen from the firm on this, is they have a hard time seeing this one pass. But of course, those are just predictions. I personally have a client that's advocating pretty hard against this, just for the simple fact that they have, you know, a lot of depreciation. They don't pay a lot of tax, and when you institute a minimum tax on book income, it could cost them a lot of money, and I imagine it will cost a lot of larger companies a lot of money. Okay. The other, another aspect of the proposals from Biden and Wyden are in relation to GILTI. And so just as a brief refresher on GILTI, pre-2017, the U.S. didn't really have a mechanism to tax profits that were earned by CFCs or were overseas, other than the Subpart F regime. And so what that meant was, generally, until a dividend was paid back into the U.S., that E&P at those entities went essentially untaxed. And in 2017, GILTI was instituted as a way to create some tax revenue on all of that deferred income. And now, as the Biden administration has released their plan, we see kind of a push to increase that GILTI rate, which of course will increase revenue. The other aspect that Biden wants to change about GILTI is that it's currently done not on a country-by-country approach. So when we do our GILTI calculations, it's all of our foreign entities. And he and his staff would like to change that to be a country-by-country approach, as opposed to Biden, who wants to institute a higher rate on GILTI and also would like, instead of taking a country-by-country approach, would like to take a high tax versus low tax approach. So jurisdictions that don't apply a certain minimum tax would be subject to the GILTI regime, versus jurisdictions that have a higher tax, they wouldn't be subject to the GILTI regime. And we'll see later why the Biden's country-by-country approach is potentially really significant for a lot of clients.
And Charles, one thing I might note right now, as we're kind of walking through these proposals, we don't have a lot of detail yet on these proposals. There are frameworks that have been provided, but we are expecting a green book from Treasury probably by the end of this month, is what they have indicated. Some people are anticipating maybe it will be coming out on Friday. That will provide some additional details and some revenue estimates as well, at least with respect to the Biden administration's proposals. So might make for some fun Memorial Day reading, at least for some people.
So moving on to the FDII proposals, and then a theme that you guys will see throughout this is that they really are only proposing to modify things that were enacted in 2017. Proposals aren't really focused on a lot of our long-standing international tax law. But with respect to FDII, both the Biden and Wyden proposals are really trying to narrow the FDII benefit for taxpayers, and they're trying to focus it on R&D and direct incentives. So generally, you were potentially eligible to get a FDII deduction for, foreign service income and foreign sales income, as long as, it was sold to a foreign person for foreign use. And so with the shift to being really focused on R&D and investment incentives, it's quite a narrowing of the potential benefits for U.S. companies. So, and we'll see that going on through the examples a little later on, that's could not potentially be a good thing for U.S. companies.
Yeah, and I think just before we go off FDII, I mean, as noted there, Biden proposed to actually repeal FDII and instead spend those savings on some direct R&D investment incentives. As Charles said, there's a lot of focus on R&D from both Biden and Wyden. Wyden's changes to FDII, which we'll walk through an example here later, are also to make it more focused on activities that are generating R&D. And I think just big picture, there's a lot of discussion with respect to increasing R&D, particularly, within the United States. One of the things that tax reform in 2017 put in place is that starting in 2022, we have capitalization of R&D expenses in the U.S. over a 5-year period for domestic research and 15 years for foreign research. And so it'll be interesting to see how that all plays out, whether or not that the capitalization requirement will be extended and such that we won't have to capitalize R&D in the near future, particularly since there is so much focus right now on proposing these additional R&D items. So it'll be interesting to see how that all plays out.
That's a good point. And I guess one other item I would add there, I think the focus on, and of course this is just, me kind of speculating, but I think the focus on R&D and investment incentives are also due to the original purpose of why FDII was implemented, which was, it was argued to make U.S. companies more competitive against their foreign counterparts who may be in a jurisdiction with a lower tax rate, or maybe in a jurisdiction where they can negotiate various incentives from state and local governments. And so I think, both Biden and Wyden see this FDII proposal as a way to arguably help keep U.S. companies competitive through R&D incentives, but also not, essentially just give away, free tax incentives to companies. So, but, not a lot about the policy has been released yet. So we'll see what Treasury is really thinking eventually. So the BEAT proposals, just I guess as a refresher on BEAT, BEAT generally works to deny deductions for outbound payments made to foreign related parties. And it was seen as a way to prevent U.S. entities from eroding the U.S. tax base. And so Biden was going to replace, or is proposing to replace BEAT with SHIELD, which is a really bad acronym. BEAT's pretty bad too, but SHIELD's even worse. And it's on the next slide, I think, so I can't exactly remember what it stands for. But basically, the proposal is to deny deductions on payments to foreign related parties if the payment is subject to a low effective tax rate, which we kind of see a little bit of the connectedness between it was on maybe the first or second slide we did with the minimum global tax versus what he's proposing to do here with BEAT, which is to say if there's no minimum global tax or tax regime, then we're going to implement this additional denial of deductions. The Wyden team doesn't necessarily have a proposal on BEAT, though they're proposing a few changes in how the calculation works, but nothing. And I should say that the changes could potentially be significant depending on the client's tax pattern, but nothing quite as significant as what the Biden administration is doing. And we'll see a little bit later on. It's still really up in the air what SHIELD's trying to do and who it would apply to. But we can cross that bridge here in a few slides. I think the one other thing I would add is that, an effective tax rate or a global effective tax rate that's acceptable for the Biden administration would be, what the GILTI rate is at. And so we'll see, with the potential of the GILTI rate changing, what they continue to say is an acceptable global tax rate. So this slide is just a comparison of what we just walked through with a few additional points that maybe getting in the weeds a bit, but definitely worth going back and just reading through, and it'll provide a good overview of the different proposals and how they are different between Biden and Wyden and how they would change the current state of play. We've got our second knowledge check here on what potential legislation you think will have the most impact.
And again, I'll leave that poll open for a couple of minutes here as we move on. It does look like most folks are answering A, the future corporate rate.
Okay, so the GILTI proposals, and feel free to raise your hand or just let us know if you have any questions. I know there are a lot of acronyms, and I get all myself, so just let us know if you have any questions. The country-by-country approach that I alluded to earlier has got a couple of open questions, and I think the two big open questions. The first one is, how would a net tested loss be treated in this country-by-country approach? And so if we step back a little bit and think about how our current GILTI regime works, if you have multiple CFCs and one has net tested income and the others have net tested loss, that tested loss will offset the tested income. And so you're effectively able to utilize that tested loss to your benefit. And if we shift to a country-by-country approach, for instance, if you have, one entity in one country with a lot of tested income, and then you have, 3 entities in another country with large tested losses. The way that it's being interpreted now is that those tested losses would effectively be lost in the current year, meaning they couldn't offset the tested income. It remains to be seen, how those tested losses could be utilized moving forward within that country. But this is one of the biggest open items, and it frankly has taxpayers a little bit concerned, and I think it should. The other big issue with this that we're not clear on yet is how the country-by-country approach will affect the foreign tax credits. And the reason that is currently we've got one GILTI basket in our foreign tax credit regime, and you can use foreign taxes paid on GILTI income, GILTI foreign source income, to offset GILTI income in another country. And so if we move to a country-by-country approach, it remains to be seen whether or not those foreign taxes in, let's say, in a high tax GILTI country could be trapped and not applied or blended with, GILTI taxes in a country that's got a lower foreign tax rate. So this is just a basic example that our Washington National Tax team put together, just kind of showing what I was highlighting with the issue around country by country and FTC basketing and utilization. Give you a minute here to just take a quick scan of the facts. Okay. So of course these numbers are made up, and because no examples were provided. But I think really what we're trying to key in on and what they're trying to show here is if you see the line for pre-credit U.S. tax, it's, 3/4 of the way down the page. And we see, we've got country X at 42, country Y at 21, and a total of 63. And then we see our 960D credits just right below those at 18 and 30. And we see our FTC limits. And then, so right under, we've got post-credit U.S. tax, and I think what they're trying to highlight is that country Y has got 30 960 credits and a limit of 21. In theory, that provides 9 left over that aren't being used to offset that 24 post-credit U.S. tax at country X, which currently, pending, some other complicated rules and having to work through the mechanics of them, are potentially in play to offset that post-credit U.S. tax of 24 at country X. So that's what this example is really trying to get at. And again, we don't have any additional details from the Biden administration. As Maren mentioned, we hopefully will have some here shortly just to see how that would work and see if there's going to be any changes, or maybe if we're interpreting this country-by-country approach to be, a little bit harsher for taxpayers than the administration had intended. This one is an example of Wyden's alternative country-by-country approaches. And so what Wyden wants to do is essentially, I think the one that has the most sticking power is apply GILTI to countries that, they consider low tax as opposed to high tax countries. So I'll give you a second to just kind of read over these facts, but when we get to the next slide, there's kind of one punchline there. So starting on the left here, on the separate C by C basket approach, that's really similar to the example that we just went over. And so when we have the high tax, GILTI high tax approach and the low tax approach, we see we have a low tax basket of country X and Z that's kind of right in the middle of the page there. And so what's going on there is that essentially the credits in the low tax countries are being cross-credited. And so they're allowing each country to apply the credit, even if they by themselves wouldn't have had, the appropriate FTC limit in order to do so.
So Wyden's mandatory high tax approach, works off of existing GILTI high tax exception rules, which, a number of our clients have already determined is more beneficial to them, to make that election. And he would change it such that it would be mandatory. And at least as shown in this example, that may be more beneficial than the separate C by C approach where you're having to calculate the foreign tax credit based on every jurisdiction separately. So we'll see how it works out as to whether or not they take the mandatory high tax approach or whether the C by C with separate foreign tax credits. And obviously every company's situation can be different. And it's important to model out, what the impacts would be to you under your own particular facts. But there are definitely two, different approaches, at least that Wyden is looking at.
All right, so moving on to the FDII proposals. So with Biden's, proposed repeal and then instituting some R&D incentives, didn't really give us a lot, and so we'll focus on Senator Wyden's proposal, which is similar but doesn't repeal FDII. And what Senator Wyden wants to do is also to narrow the approach to just R&D. But what he wants to do is change the calculation and include, I think it's deemed innovation income. Yep, there it is. So we would replace deemed intangible income with deemed innovation income. And so deemed intangible income is part of the FDII calculation, but was sort of what I was getting at earlier is ultimately there are a bunch of different definitions that sort of roll up into one another. And ultimately the idea is you're getting a benefit for like foreign sales or foreign services provided to foreign parties for foreign use. And what Biden would do is just change that definition such that it's essentially foreign R&D investment that you would start to get the benefit for, which would really narrow down the FDII benefit for U.S. companies. And you can see here on the slide.
Sorry, Charles. I was just going to say, much of the calculation would remain the same. However, that calculation of DII would now be based on innovation income. So theoretically, U.S. R&D expense and job training expenses and those types of expenses times the percentage, which isn't yet defined. We'll go through an example here in a moment where we picked a percentage to show you how it may work. But so DII and the calculation of that would be the primary change. And then looking at your ratio of foreign derived DEI over DEI deduction eligible income would be similar theoretically to how it is calculated now. So the major change here is in the calculation of DII and that innovation income, as well as the removal of the 10% of QBI. So I don't know if you want to go on to the example.
Yeah. So the example here we see in the top left-hand corner, we've got various expenses, some of which look like they might be eligible for deemed innovation income. Then as we go just directly down to number 1 there, computing your deemed innovation income, we see, job training and research and expenditure, which we're classifying as innovation costs. And we currently don't know exactly what innovation costs exactly will be, how they'll be defined, but just assuming now that job training and R&E would be included there. And then we have, a specified percentage. So of course, there's going to be a little bit of a haircut on those. They're not going to give you a benefit for the total amount of the cost. We've assumed 25% here. That could be a conservative assumption. But really it's just for, illustration. The Wyden plan doesn't include a specified percentage. So we see we've got the 187.5 of deemed innovation income essentially. And then over to number 2, we'll compute the foreign derived ratio. And so we see we've got, deduction eligible income and today, which is 600. And so got a foreign derived ratio of 33%. And so I think, the DEI and the FDII are essentially staying the same in Wyden's proposal. And so we apply the 33% to the 187.5 of the innovation cost, and you get a FDII benefit of 62.5. I think really, I've mentioned it a few times, but what's key there is that, the innovation costs in theory will just be much smaller, or potentially could be much smaller depending on your business model and what type of business you're in than the current potential benefit. But that's what this example is trying to get at. So then moving on to it probably should say SHIELD proposals, but it says the couple of open questions, and really the biggest open question is how SHIELD is going to work with our other proposals and how it fits within our regime. And the reason for that is if we're proposing a minimum global tax rate and we already have a GILTI regime and we set the SHIELD proposal rate at the GILTI rate, and we say, okay, our outbound payments or our outbound deductions, as long as they are being subject to a certain tax rate, the GILTI rate, which in theory they all should be, then we're not going to institute any sort of additional tax on those. So SHIELD would effectively be inapplicable. And so that leaves us kind of wondering, what exactly does SHIELD apply to then? So that's the first real big question. The second question is that, we don't exactly know what deductions or outbound payments SHIELD is trying to target. Our current BEAT rules, as you guys probably know, have very detailed regulations about the various types of outbound payments that are going to be subject to BEAT and the ones that are not subject to BEAT. And so we just don't have any of that right now for SHIELD. And so when you add that on top of, we're not exactly sure which taxpayers this could apply to, you get a lot of uncertainty, but hopefully we'll get something from the Green Book that Maren mentioned. So we could go on to the next slide here. And this example is just trying to get at the point that I was making, that we're not really sure who it would apply to, but these are two scenarios that we've kind of thought up that potentially SHIELD could apply to. And so the first one on the far left-hand side, you've got a foreign parent, and then you've got the U.S. parent, and presumably the U.S. parent has got some CFCs underneath it that aren't pictured here, but you have a deductible payment from the U.S. parent to the foreign parent. That potentially wouldn't be subject to SHIELD, just based on our current ownership rules that we have in our B regime. We wouldn't have classified that as a deductible payment. And then the other one would be the U.S. parent paying, essentially to a brother-sister sub that is a foreign one, but wouldn't be a CFC. So this one is Senator Wyden's proposal, and as I had mentioned, Senator Wyden, I guess it's not, I really wouldn't even call it a proposal as much as it is just playing with our beat calculation. And what he would do is allow the full value of domestic business tax credits to be included in the computation, and would increase the beat rate to an unspecified percentage on the portion of modified taxable income. And so just depending on the fact pattern that you have, it could have a large effect or maybe no effect at all. But I think, we probably don't need to get too far into the weeds there on how the calculation itself works. It's pretty complicated and mechanical, but those are the two key points for Senator Wyden's proposal. Got another knowledge check. How likely are you to engage in reverse tax planning if tax rates go up by 7%?
I'll keep that poll open, and it looks like most people are answering B, probably.
Which would make sense to me. So the next slides are based on planning ideas, and they are pretty in-depth. And so I don't want to get too far into the weeds. I think we can classify the next, I'd say, 5 or 6 slides into 3 categories of planning ideas, essentially. The first one would be, as the title says, GILTI and gain acceleration. And so the basic reason you would want to accelerate gain and pay more GILTI now is, one, if the GILTI rate is going to go up. That is just, simple math. You pay less tax now than you would, potentially a year or 2 from now if anything was actually enacted. And so one thing clients are looking at is just to go ahead and engage in any transactions that may be on the table, but they haven't pulled the trigger on, or to engage in methods planning to accelerate some income. The other reason you may want to do that, like we mentioned, is the FTC issue that came up. So right now you can currently cross-credit and potentially utilize more FTCs. And so you potentially don't leave those benefits on the table. If you wait and the country-by-country approach from Biden gets enacted, then you potentially leave those on the table. I think we can go, here we go, yep. The other one, and this is just kind of a general corporate idea, and then we've actually had a client do this, is just use, some accounting methods planning to accelerate income while the rate's at 21%, as opposed to a scenario where the rate's at 28% or somewhere in between, just trying to take advantage of a lower rate. The other aspect there is if you have a potential FDII repeal, then then you may also be able to continue getting that FDII benefit before it may or may not be in place anymore.
Yeah. I mean, I think that, you know, the big picture point is that with the change in the rate, similar to when we saw the rate going down, but doing the reverse this time where we are trying to accelerate income or defer deductions to get a permanent benefit associated with the rate change. And that clearly can be done at both the U.S. corporate level as well as, you know, from a GILTI perspective. And having to think through kind of all of the secondary impacts to that, you know, what does that mean, say, for your FDII calculation or things, but those may also be favorable. And we have a lot of clients considering, well, you know, is there planning that we can do that's kind of, as we're calling it, you know, no regrets planning that doesn't hurt me one way or the other, even if the rate doesn't end up going up as much. Because, for example, there can be benefits to accelerating your FDII, just the way that the FDII formula works, to accelerate FDII into a particular year and increase the amount that's eligible, either through, you know, accelerating the income, maybe through a prepayment or something, or deferring deductions. And so bunching that together can give you a benefit, even if nothing changes, even if FDII is not repealed. So things to consider right now that you may want to do in any case.
Yeah, and I think we can move to the next slide. Yeah, and so I guess, you know, the one last point I heard Maren mention it is that the other thing you can do is defer deductions until, you know, we have a higher rate. And an example of that would be, you know, opting out of bonus depreciation until, you know, a little bit later on when you see, okay, now the tax rate's at 25% or 28%. But otherwise, I think, you know, those are the three major themes that we've seen and that clients have been considering as a result of just the various proposals from the Wyden and Wyden groups. So I think we can move on to our compliance updates as we're only got about 15 minutes.
We are running a little bit short on time, but one final comment, I guess, with respect to, you know, planning and what you want to do, and from a, you know, timing perspective. Certainly some of the slides walk through, and I'm sure most of you are familiar with, you know, accounting method changes and the various timing implications and things that need to be thought through. But one thing to note is that similar to when we had tax reform in 2017, there are certain steps you may want to take sooner rather than waiting until the end of the year if you really do want to accelerate income or defer deductions. It is possible that once legislation is actually released, which potentially could be in the summer, anything after that point in time, maybe you might not be eligible to do. We certainly saw that in 2017. So that's just something to keep in mind from a timing perspective. If you want to, say, make prepayments or some of amounts, say, to increase your FDII benefit, that may be something you would want to enter into before any legislation came out. And again, you'd want to factor in, you know, is there any downside, you know, to doing that, which there may or may not be. So one thing just to note, and then I guess the other final comment to make is just with respect to needing to kind of, you know, model out how it impacts all of your calculations and not to forget the state tax consequences and to consider those as well. So I think this slide here just has, that Yanni was just on a moment ago, you know, had some ideas with respect to how you might either accelerate income, defer deductions. So I think in the interest of time, we will also move on now. I guess we have a knowledge check first. But then moving on to our compliance updates as well. I think the first thing that we wanted to highlight is something that actually doesn't impact the 2020 compliance year, but is something that will be coming for 2021 to the extent that you have partnerships or S Corps that have international operations, whether you're actually preparing those or, receiving, say, Schedule K1. So the IRS has issued released draft Schedules K2 and K3 for international reporting purposes for both partnerships and S Corps. And these forms aren't finalized yet, but they have been issued in draft 2 times, once just recently at the end of April. We don't have any instructions for them yet either, but expecting to see that maybe late summer, fall timeframe. So the information, and Leonie, I think we can move to the next slide, that's currently provided for international reporting on a Schedule K and that shows the full partnership information, and then the K1 that shows the partner's share of that information is fairly limited. Right now, it's just kind of through line 16 on the Schedule K and then through some additional footnote disclosures for GILTI and FDII and things like that. And these K2 and K3 schedules will standardize how the information is provided to partners and S Corp shareholders. The K2 is designed to show the full partnership information, whereas the K3 is the partner's share of that. And the IRS has noted that they don't think this information is new. It's something that should have already been provided to partners. However, in practice, we see that the information was often not provided, or it certainly wasn't provided in the detail that it appears will now be required. The schedules themselves are around 20 pages long, so they're going to take some significant additional time to work through and complete. The next couple of slides note just the type of information that is required on the schedules. It's broken out into, I believe, 9 sections. We won't walk through all of those, but it's really just to make you aware that there is this increased compliance requirement, and there may be a potential need to gather some additional information. And again, this will apply first for the 2021 filing season, and will apply for partnerships, S Corps, as well as Form 8865 for foreign partnerships. So we wanted to make you aware of that. The remaining compliance updates that we'll cover do apply for the 2020 tax year. The slides are broken out by type of form and highlight what's new in the current year. And we may not have time to get into all of the details on the slides, but as mentioned at the beginning of this, the slides will be provided to you for reference. So to the extent that you are working through compliance and have any questions on these new requirements, we're happy to, separately talk through those. So Charles, you want to start talking through some of these?
And the majority of the updates have been to the Form 5471, which is used to report CFC operations, and so hopefully we can make it through those. The initial update are in relation to the category of filers. And so, pre-TCJA, there were only a handful of categories, but now, we're up to 9, and category 1 is divided into 1A, 1B, and 1C, and each subcategory is, different and requires the taxpayer to report different information. And so that's the first thing to be aware of, is just they're pretty methodical and mechanical, but you'll have to work through all of the various categories to determine, what your CFC falls into. And luckily, if they didn't engage in any, major transactions over the year, likely continue to be in the same categories that they were in, which is helpful, but definitely need to read through those. Here, we see, so on the right-hand side, we just see where they've got the new categories, and then on the bottom of the page we see.
And I think we need to move forward a slide.
Okay, so we're moving on to Schedule G. This schedule is new, and well, it's not a new schedule, but they have a couple new questions on the schedule related to Section 245 Cap A, which is our dividends received deduction. You're potentially eligible for a 245 Cap A deduction if the CFC is paying a dividend to a U.S. parent, subject to a handful of different ownership rules. And so there's two new questions on this Schedule G, 22A and 22B, which are getting at those. So those, you should be aware of those in case your CFC paid a dividend. And I think that's what this is just going on to show. So Schedule I has been expanded significantly. Most of the questions are also in relation to, the dividends received, Section 245 Cap A rules. We see, new lines 1C, 1D, 5, and 8 relate to extraordinary disposition amounts, which are rules that apply to the 245 Cap A dividend. So Schedule I has been expanded to include all of those, something to be aware of. And this is just what this is just being shown here on the slides, so you guys can see where within the forms these various updates have been made. So moving on to Schedule I-1, if we could go back one slide, one more slide. There we go. This is our slide that we use to report the information for GILTI for the various CFCs. Basically, what this slide's trying to show is just that we've got a few updates. We've got the exclusions there on line 2 and our subpart F income, and a few items on the side we wanted to highlight that, the subpart F income there won't equal the subpart F income on our Schedule I, which was our previous schedule that we were referring to. And on that schedule, one of the questions asks for the subpart F income of the CFC. And so we just wanted to highlight that for you guys. This is just some additional information from the I-1. One of the items that I think people are working through now are the GILTI high tax exception, which is now, you can see that in line C. But otherwise, the I-1s generally remain the same. So Schedule E, new items on the Schedule E. Schedule E is used for foreign taxes, paid, accrued, or deemed paid. And the biggest changes here is that as we've gotten a better idea of what the various PTEP, previously taxed earnings and profits, what the various types of PTEP are, the service has expanded, or I should say adjusted the Schedule E and E1 just to reflect, the 10 categories of PTEP. I think maybe initially, during tax reform in 2017, we had potentially a bunch of different categories of PTEP, and as we started to narrow those down and kind of put a finer tip on the groups, the services has changed the Schedule E1 and the Schedule E to reflect those.
And I think we're getting a little bit short on time, so maybe we will move forward to the Schedule R slide. Schedule R is one of the new forms in the 54 new schedules in the 5471, Schedule R and Schedule Q.
Yeah, so Schedule R, as Maren mentioned, is brand new, and it's for Category 4 and 5A filers. And this is just information on distributions from a foreign corporation. And so a lot of the information that we've seen on the previous schedules related to Section 245 Cap A and our PTEP amounts will be displayed on this slide, but essentially the service wanted to get an idea of the distributions and the various information in relation to those distributions. And so this is a new schedule that will need to be included if a distribution is made. And here, this is just in Schedule Q. So Schedule Q is also a new schedule for Category 1A, 1B, 4, 5A, and 5B filers. And essentially, it's used to report the foreign corporation's income, deduction, and taxes and assets by CFC income groups. The income groups being, Subpart F, GILTI, passive income. And so I think this is just another way that the service is trying to essentially get their hands on various amounts of information and understand income and expenses and assets of the CFCs in different ways, which continues to be something that we see each year. They're expanding the 5471. It seems like every year since 2017, so they can get more information about the CFC's operations.
Yeah, and the Schedule Q is used to provide the information to show how the high tax exception, for example, taxes and the income that the high tax exception can be calculated, and a variety of things like that. So I think maybe we can jump ahead to talk briefly about the Form 8991, which is the BEAT form. Something new there is a Schedule B to show the disclosed waiver of deductions. Under the BEAT regulations, you can choose to waive certain deductions, which may be beneficial to get below the thresholds for BEAT, the 3% threshold, and therefore make BEAT not applicable to you. So that is a new schedule for the Form 8991. And then on the Form 8992, which is the GILTI form, there are a couple of new requirements there, one being that U.S. partnerships are now required to file the form, even though the actual GILTI inclusion is not something that is included in the partnership income, but rather is passed through the partners. Part of the form is still required by U.S. partnerships. The other major change from the Form 8992 for GILTI purposes is when you have consolidated taxpayers, you have just one consolidated Form 8992 that's filed with the return. You do separately prepare 8992s for each U.S. shareholder of a CFC, but you don't file those. You just keep them in your records, although you may also need them for state filing purposes as well. So I think with that, we'll stop there. Apologies for moving through those pretty quickly, but again, if you have any questions on those compliance changes this year, we'd be happy to discuss those separately. So Julie, I don't know if you have any closing remarks.
All right. Thank you again, everybody, for joining today. Please remember to log out of the poll everywhere. Leonie will go over those instructions in just a minute. If you do have any follow-up questions at all from this training today, feel free to reach out to a member of your team or to myself, and we will definitely get you hooked up to have a chat with Mary. Otherwise, we thank you again for attending, and watch for the slides to come out over the next few days. And we will get an invite out for our next live webcast that will be in August. You'll probably see that come out sometime in late July. Thanks again, everyone. And Leonie, did you want to briefly talk about the logout?
Yes, I'll just note that, I'll note that checkout will stay open here for the next couple of minutes, even once the meeting has closed. So you'll want to go to Poll Everywhere and submit your first name, last name, and email address to complete the checkout process.